Ever wondered how inflation impacts your finances? It's a question that bothers many, so let's dive right in to clarify what inflation is, why it happens, and how it impacts your purchasing power. Inflation, at its core, is the rate at which the general level of prices for goods and services is rising. When inflation goes up, every dollar you own buys a smaller percentage of a good or a service. It's like a stealthy thief, slowly but surely eroding the purchasing power of your hard-earned money. But why does inflation happen? There are several causes, but let's focus on two primary ones. First, demand pull inflation, which occurs when demand for goods and services surpasses their supply. Think of it like a bidding war at an auction. When more people want a limited item, they're willing to pay more, and prices rise. Second, cost push inflation. This is when the costs of production, like wages and raw materials, increase, and businesses pass on these costs to consumers in the form of higher prices. Now let's talk about the impact of inflation on your purchasing power. Imagine you have $100 today. If the inflation rate is 2% per year, a year from now, you'd need $102 to buy the same goods you could have bought today with just $100. That's the power of inflation, slowly eating away at the value of your money. But don't panic just yet. While it's true that inflation can erode your purchasing power, it's not always a bad thing. Moderate inflation is a sign of a healthy, growing economy. It's only when inflation rates spike or are too low that problems can arise. So, understanding inflation sets the foundation for our strategies ahead. It's a key player in the financial world, and knowing how to navigate its ups and downs can be the difference between your money losing value and your money working harder for you. Stay tuned as we delve into how to not just survive, but thrive during inflation. Now, how can we protect our wealth during inflation? One way is through real assets. Let's take a moment to understand what real assets are. These are tangible or physical assets that have intrinsic value due to their substance and properties. Unlike financial assets like stocks or bonds, which derive value from a contractual claim, real assets get their value from their physical traits. Examples of real assets include real estate, commodities like gold and oil, and even collectibles like art and vintage cars. These assets are often considered a reliable store of value because their worth doesn't get eroded by inflation as easily as money does. In fact, in many instances, the value of these assets tends to rise with inflation. Let's delve deeper into a couple of these. First, real estate. It's a popular choice among investors looking for a hedge against inflation. As the cost of materials and labor goes up with inflation, so does the value of properties. Additionally, if you're renting out your property, you can increase the rent over time, keeping pace with inflation. Next, commodities. Assets such as gold have been used for centuries as a hedge against inflation. When the value of money falls, the price of gold typically rises. It's seen as a safe haven during turbulent economic times. Similarly, oil and other commodities can also serve as a buffer against inflation. However, remember that investing in real assets also comes with its own set of risks. For instance, real estate markets can experience downturns, and commodity prices can be volatile. Therefore, it's crucial to do your homework and consider your risk tolerance before investing. Investing in real assets isn't just about protection against inflation though, it's also about diversification. Having a mix of different types of assets in your portfolio can help spread your risk and potentially increase your overall returns. Investing in real assets can be a powerful strategy to protect and grow your wealth during inflation. With the right knowledge and a well-thought-out strategy, real assets can indeed become a valuable part of your financial arsenal. What about the stock market? Can it weather inflation? Yes, with the right strategies. Inflation can be a daunting concept for stock market enthusiasts, but fear not, there are ways to navigate these choppy waters. One strategy is to focus on sectors and stocks that historically perform well during inflationary periods. Typically, these are companies that can pass increased costs onto consumers without much backlash. Think industries like energy, where higher prices can be a boon, or consumer staples, where demand remains relatively stable even when prices rise. Then, there's dividend investing. Dividend-paying stocks can offer a cushion during inflationary periods. These companies regularly distribute a portion of their earnings to shareholders, providing a steady stream of income that can help counteract the eroding power of inflation. Plus, many of these companies are in sectors that tend to fare better during inflation, like utilities or consumer staples, making them a potentially smart choice. But let's not forget about the importance of diversification. Even in times of inflation, it's crucial to maintain a diversified portfolio. This means spreading your investments across various sectors, asset classes, and even geographies. Diversification can help mitigate risk and smooth out potential bumps in the road. Consider this: if all your eggs are in one basket and that basket happens to be a sector heavily impacted by inflation, you could see significant losses. But if your investments are spread out, the impact of any one sector's poor performance is likely to be less severe. So, while inflation can indeed pose challenges for stock market investors, it's not an insurmountable hurdle. By focusing on sectors that typically perform well during inflation, considering dividend-paying stocks and maintaining a diversified portfolio, you can navigate this economic phenomenon with confidence. Navigating the stock market during inflation requires strategy and diversification. Bonds and inflation, do they go hand in hand? Not always, but there are alternatives. Now, traditional bonds may take a hit when the inflation rate rises. Why? Well, the fixed interest payments of a bond become less valuable as the purchasing power of each dollar decreases. But don't fret, as there are options out there to help shield your investment from the impact of inflation. One such option is Treasury Inflation-Protected Securities, or TIPS. These are U.S. government bonds designed to provide protection against inflation. So how do they work? Well, the principal amount of TIPS adjusts with inflation and the interest is paid semi-annually at a fixed rate. But here's the catch: the rate is applied to the adjusted principal. So as the principal goes up with inflation, so do your interest payments. Neat, isn't it? Now, let's talk about corporate bonds. These are bonds issued by companies. While they generally offer higher yields compared to government bonds, they do come with a higher risk. However, the higher interest rates can help offset the impact of inflation. Just remember, corporate bonds are subject to credit risk. So, make sure to do your due diligence before investing. Other fixed income options to consider are inflation-indexed bonds, floating-rate notes, and inflation-adjusted savings bonds. These instruments have mechanisms in place to adjust with inflation, which can help protect your investment. While they may not offer the highest returns, they provide a measure of safety against rising prices. Of course, keep in mind that while these options can help shield your investments from inflation, they are not without risk. Always consider your risk tolerance, investment goals, and the overall economic climate when making investment decisions. So, there you have it. Bonds may not be the best friend of inflation, but with alternatives like TIPS, corporate bonds, and other fixed income options, you can arm your portfolio with tools to combat rising prices. Remember, diversification is key, and these bond alternatives can be a valuable part of your inflation-beating strategy. We've covered a lot of ground today, haven't we? From understanding the basics of inflation, we've journeyed through various financial strategies to not just withstand, but prosper during periods of rising prices. Let's take a moment to recap. Inflation, at its core, is the increase in prices over time, eroding the purchasing power of your money, but it doesn't have to spell disaster. With the right strategies, it can become an opportunity. Investing in real assets emerged as a powerful method to hedge against inflation. Real estate and commodities, from gold to oil, can hold their value even as prices rise. They offer a tangible shield, protecting your wealth from the corrosive effects of inflation. We also delved into the world of stock market strategies. The market isn't immune to inflation, but understanding its dynamics can help navigate these choppy waters. Investing in sectors that traditionally perform well during inflation, focusing on dividend-yielding stocks, and maintaining a diversified portfolio can all help to mitigate the risk. But what about bonds? Traditional bonds might lose value in an inflationary environment, but that doesn't mean you should steer clear of fixed-income investments altogether. We explored Treasury Inflation-Protected Securities, or TIPS, along with corporate bonds as alternatives that can offer a certain degree of protection against rising prices. And let's not forget the power of entrepreneurship and side hustles. Inflation can open doors for those willing to seize the opportunity, adapt their existing businesses, or start something new. Your knowledge and skills are assets too, appreciating over time, enhancing your earning potential during inflation. Strategic debt management also emerged as a key tool. Refinancing, leveraging low-interest debt, and using debt for income-generating investments can all be part of a smart strategy during inflationary times. But above all, a robust financial foundation is crucial. Savings, emergency funds, and liquidity are all vital to navigate unexpected expenses during inflation. Remember, the key to thriving during inflation lies in understanding it and adjusting your financial strategies accordingly. Stay financially savvy.